Hello everyone, today is December 17th and this is our swing workshop on Wyckoff method. I'm usually very excited about this event because it's a day-long event. We're going through a lot of material. A lot of material is going to look like a repeat, but combining it all together into a single comprehensive idea as to how we actually select the stocks for our swing trading. How do we actually select the correct stocks? Excuse me. What are the nuances of that selection? And why specific selection is going to bring us more profits than what seems to be maybe a selection of a peer. How do we actually get into the position and how do we leverage our swing position? Because for a swing trader, you have to think about how much money you can make in a very short period of time of your time frame, and how could you leverage that so that your P&L would increase not just with the movement of the stock, but also with the leverage that you can use, or with the leverage on the selection that you can use. So all of those more advanced ideas we're going to discuss today. We're going to talk about all of those nuances. So I would definitely pay a lot of attention to those. But at the core of our conversation is still going to be Wyckoff method. Is still going to be the ideas of what are we basing that selection on. So quite an interesting event every time I conduct it, and I'm always looking forward to it. So I welcome all of you to today's session. So let's talk about some of the things that we need to discuss before. We're going to have 4 parts to this workshop, and I did send you 4 webinar links. Now, the reason why I sent you 4 webinar links and not 1 is because I want to have smaller videos, and obviously I'm going to be recording each of the sessions, and it's just easier to record a smaller video and then convert that and then to start the new one. So we'll have those breaks in between those 4 sessions. One of the breaks is going to be a lunch break, so I need to stop also, and kind of like catch a break and catch a breath a little bit. And for you, that's going to be an opportunity just, to relax. There's going to be a lot of material. I will be talking a lot. I will be giving you a lot of the material, so I think those breaks are very much appropriate. And we've done this before. That seems to be working, at the kind of like most optimal level for me and for you guys. So let's make sure that we are on time on all of the breaks. I'll try to make breaks based on the content, but sometimes we'll not be able to do that. So we'll just stop on a specific slide and then we'll come back, and it's not a big deal. But that's going to be our scheduling. So I will be recording all of the 4 sessions. You will have the access to all of the 4 sessions, and I will send you the new deck of slides. I've actually added, a couple of slides to the deck that I've sent to you. I made some of the additional edits that I didn't want you to see right away in the file that I've sent you. So, don't freak out if I go through the slide and you don't have it. It's okay. I just deliberately put some of the slides away, and I will send you those slides either tonight or tomorrow morning once I have. Actually, what I'm going to do is I'm going to encode all of the videos, post them on the website, give you the access to the page, and that page is going to contain the updated version for the slides. So I think that would be the best. Now, my master file for this workshop is 128 slides. Your deck of slides contains about 100 slides, I believe. So one of the blocks that I didn't send you is the solutions to the exercise at the end of the slide deck. Now, I don't know exactly where we're going to stop, because last year when I conducted this workshop, we stopped around like 5 o'clock. So we went beyond, and that was without addition of the new slides that I have for you guys today. So we will have to see whether we will be on time with the exercise or not. If we're not on time, I think what would be appropriate for you guys to do is just to do this exercise by yourself if we're not on time, but we'll try. And then just go through the solution slides. So that would be my advice. Okay, and just to remind you that all of the video recordings that we're going to have today, it's only for your personal use. So please don't spread the password, to the page where all of the videos and the slides are going to be stored. Also, as I mentioned before, I have sent the GoToWebinar links for each of the 4 sessions. So what I'm going to do is, once we are about to go on the break, I'll announce this again, but once we are done with the first session, I'm going to start the encoding for that video, and right away I'm going to log in and open the second session. So you will have a chance to log in right away and then go and have your bathroom break, your coffee break, and then come back. So I'll try to accommodate you guys as much as possible. Tomorrow, or maybe even at the beginning of the next week, we will be sending you evaluation form. We want you to give us feedback. That's been a very good practice for us throughout all of our classes, throughout all of our workshops especially, and a lot of your recommendation, guys, and not all of them, but a lot of them, I listen to that. So it's extremely important to me to understand how you learn the content. So please make sure that you devote maybe like 10 minutes of your time, and send me the evaluation form back. And I just hope that we're going to have a great time. I'm very buzzed, about this event, so I have a lot of energy today. I've rested yesterday just to have, this type of energy for this such a long event. So let's go to work. And there is a lot of material in front of us. Let's just, start. Okay, as usual, this is only for educational purposes only. If you'd like, read this disclaimer later on the video. Primarily, we do have either our alumni attending this workshop or current students from Advanced Wyckoff course, from Wyckoff Practicum, and thank you guys for signing up. And we have probably just 1 or 2 people who are not familiar with our community or with our products. So just a quick note about myself. I'm not going to, talk a lot about this. Primarily, I just want to say that I've started studying Wyckoff method 20 years ago. Yes, it was 1996. Took my first classes in Wyckoff with Hank Pruden and Bruce Frazier. Met a lot of great Wyckoffians in those classes that have become, money managers, technical analysts, registered investment advisors, and that used Wyckoff, in a way to manage money. So I was kind of lucky that way. Then I did a lot of back testing. It took me years just to back test this whole methodology and just to come to a very confident place of where I could actually trade. My first attempts to trade the method were somewhat unsuccessful, which was really frustrating. So that led me to study the method in a much, much deeper level. And then after that, I think 7 years ago, I started teaching the method. First, in the private sessions and then in classes both at Golden Gate University and private classes. And today's product, what we're going to go through today, is it's a product of 20 years of studying, trading, going through thousands of charts, tens of thousands of charts, and trying to understand the reasons of why the price moves the way that it moves. And there are definitely a lot of discoveries that I found during this path. So all of this, and specifically for swing trading, I'm going to show you today. And those are going to be major ideas. Probably 90% of all of the ideas are going to be in this workshop. All right, so enough about me. Let's talk about the workshop itself. I did send you the syllabus, the outline for today's session. So I'm going to go through this somewhat quick, but there's going to be some spots that I'm going to emphasize. And I want you to make maybe a note on your slides if you printed those out. And actually, I do suggest to you, you received the file from me with the slides. Print those out, and as we go through slides, make some notes there on the slides. There should be a lot of space for you to do that, and probably that would be the most efficient way to work today, with the slides and with me on this material. So we've covered the introductions. We'll talk about the definitions of swing trading. I actually don't like quite a lot of those definitions. I think they're somewhat impractical. I think that they've been written by some people that actually do not trade. Or maybe I'm a little bit subjective based on how I swing trade, or how my students swing trade and what kind of time frames they use. So we'll talk about that. Then we'll talk about, general characteristics of the ideal swing trade. We want to mentally project what kind of trade we're going to have, starting from the selection. And we want to find that selection, to be the selection that's going to not just bring us to a positive P&L. We want to understand our selection much deeper. We want to select the stock that's not only going to go in our direction, but also is going to outperform not just the market, but the peers as well. We'll talk about, different elements of that general characteristics like readiness, momentum, trend, trade management, leadership. We'll touch upon the risk management and reward and risk optimization, and that all is going to go into the idea of how could we leverage, how could we maximize our profits during the swing trading if we are heavily concentrated in specific swing trades. So we want to be bold, we want to be big, and with the control of the risk that we have, we want to make sure that if we win, we're going to win big. And through this whole session today, we're going to talk a lot about the optimization of our trading. What are the best practices? What are the best selections? What are the best entries? What are the best risk management ideas, and so on and so forth. Then we'll talk about the technical characteristics, and specifically we will talk about step-by-step approach as to how do we actually go from identifying what the market is doing to the actual points of entry and actual points of exit. And the way how I want you to work with this outline, I want you to notice two colors here. One is green, one is red. The red one identifies the steps as to what you should do first in your analysis for your selection, and then obviously trading of those swing trades. And then the green color I'm giving kind of like the identity to the question, identity to the idea as to what we're actually looking for. So for instance, the first one here, synchronicity with the market. In which direction are we trading? Are we swing trading? Are we trading in the sync with the market trend, or are we trading counter trend? And I've shown you guys, for those of you who are my students, or current students or alumni, or maybe you just watched some of my YouTube videos, I've shown you quite a few counter trend trades, and just recently I've posted the video blog on the S&P trade, which was a counter trend trade. I'm sorry, not S&P, but NASDAQ. And we'll talk about some of those, not in the extension, but still we'll talk about what are the high probability selection candidates for us based on the synchronicity with the market. I mentioned about different definitions for the type of swing traders that we have. So we'll talk about that. We'll talk about my definitions, and then after that, and this is kind of exciting for me today because this is the first time that I present this material. We'll talk about the market trend definitions. There was a question during this current cycle of the advanced Wyckoff course as to how do we actually define the market trend in a more quantifiable way. And I thought about this, and I just did a very simple visual quantification of the market trends. So we'll go through that as an exercise, as a case study. And I've added something that you don't have on the slides there, but that was very intentional. So, don't freak out if you see some additional notes there or additional slides. And that would be our step number one in our trading. And this is what you have to do on a weekly basis. So we'll go through that. Then we're going to talk about, as a step number two, as to now that we know how the market, where the market is in the whole structure, we'll talk about what are the appropriate selection candidates for us, and we'll go through different selection categories. We'll talk about the selection based on the relative comparative analysis, and that would be the first step for us in that process. We want to define what exactly are we going to trade, and we'll talk a lot about how do we actually find it. And I'll give you different tools, and we'll talk about those different tools. We'll also talk about the a continuation of that selection process, and we'll talk about specifically as the next step. And usually we'll talk about the structure, but I think this is kind of like a very common mistake for the beginners and intermediate traders, not to necessarily go and discuss the peers in the industry group that of the stock that you're looking at. So usually during the market outlook session, somebody's going to come, bring the chart of the stock, and in our discussion for this particular selection, I would usually say that, do you have anything else in the same industry group which might be outperforming, something that is in a better structural place, in a better relative standing. So we'll talk about this as our next step. And then obviously after that, once we see that maybe a couple of candidates are the ones that we are going to be extremely attracted to, we do want to go through the structure analysis for those candidates and understand where they are in the structure. And this is something that is going to be very common to the majority of you, so this is the material that I will try to go through very quickly. Yet, we will stop and we will talk about some specific things that are related to swing trading, and that is, defining where we are in the structure, given where we are. What are the best swing trades that we could expect from that point on? And that's an extremely important idea there. Then we'll talk about supply and demand confirmation. And again, it's not something that we haven't talked about in the advanced and Wyckoff practicum. But there are specific ideas that are related to swing trading that are going to be extremely important. And specifically, I'm going to emphasize today a decrease or increase of volatility as a filtering tool. And the emphasis here is going to be still on the selection and not necessarily on the confirmation. You will see the supply absorption, which will act as a confirmation for us, to go into this position. But if you have 3 or 4 or 5 stocks, to choose from, one of the selection categories is going to be based on the volatility between those stocks. And this is something that I've added to the deck so you don't have those slides. So we'll talk about that. And then everything else is going to be about tactics and management of our swing trades. So we'll review some, entry points, stop losses, exits, and then we'll talk about switch technique. So switch technique usually excites my students, and the reason why is because we always want to have more profits. So, and it's a very human idea. We can't really disassociate ourselves with that. We want more. So, and the switch technique is just one of the ways of how to control your risk and to get a much better alpha. So we'll talk about that. And I did mention that during the advanced Wyckoff course, but today I just want to concentrate on that specific technique. And then, as I said, if we have time, we're going to go through the exercise on Sketchers. If not, then you can do this yourself after the workshop as an extra opportunity, to work on the charts. And if time permits, we'll have a Q&A session at the end. I don't mind staying maybe until like 5, maybe even slightly beyond 5 p.m. Pacific. I also will have to see how I feel, guys, because I mean it's a lot of talking, the whole day. So we'll just have to play it by ear. But that's basically our outline for today, and it's a lot of material. So let me talk a little bit about how we're going to conduct our sessions, how we're going to interact with each other. So primarily, I will be expecting you to ask some questions through the question box that you have on your GoToMeeting. So feel free to enter any questions, and I would urge you to be in line with the content, right? So ask me a question that pertains to our current discussion, and that would be the most beneficial. That would be in flow of the thinking that we are developing on a specific slide. If you have a question that is maybe not related to the specific slide or to the specific content that we're discussing, keep this question for the Q&A session, and I think that would be the most appropriate time, to do that, to ask that question. Also, I did ask you to send me back the audio release forms, and I've got quite a few of those. So those are were sent to you with an idea that there might be some kind of interaction, actually a live interaction, that would be recorded. And the reason why we want you to send us that release is because we want to use these videos, for future sales, and we want to respect your privacy, and if somebody does not want to be recorded, that's totally fine. We don't want to push anyone. And I don't even know if we are going to have any discussions, if we're going to hit that, exercise on Sketchers. But if we do, then I definitely would like to work with those of you who have sent me a release, and primarily, maybe like 1 or 2 people maybe 3, 4, just depending on how deep we're going to go into all of the slides. But with that exercise, any live discussions, I definitely would like to interact with the people who sent me the release. I also will restrain myself from mentioning your names, guys. Again, it's for the purposes of the recording of this material, and I want to be respectful of your privacy. So if I'm reading a question and I'm not mentioning your name, that's not because I don't want to say your name, but just because I really would like to limit any type of exposure for any students that we have here today. Okay, I think that's it for all of the introductions and, you know, going through kind of like some of the main points that we're going to discuss. It's always customary for me in any of the cycles that I start with students to set an intention, and that was that exercise. We were setting an intention for what we're going to do today, all of these steps, all of those definitions that we're going to go through. So let's start. Our next break is going to be at 10:20. So we have an hour and 20 minutes, which gives us, you know, a good time to go through a big first initial chunk of material. So let's talk about the swing trading definitions. And here on this slide, I'm asking a couple of, few questions here on our, definitions for the swing trading. The first question is, how do you actually define a swing? And for those of you who have taken, previous classes, you guys know that we would look at the specific reversals of the swing. We'll go through this technique today. I'll remind you about how we look at that, and we'll use that extensively, especially during the trade management block. But I always, when I talk to students and when they say, oh, I'm a swing trader, I always want some clarification. I want to understand, how do you define the swing trade? And therefore, how do you actually define the swing by itself? And then what is that time frame that you swing trade in? Because there are quite a lot of traders that think that a specific time frame is a swing trading. And I think that there is a much more complex definition for swing trading. And so therefore, I always would like to know if you're a swing trader, are you a short-term swing trader, or you kind of like a long-term swing trader? Some swing traders, could trade only for a couple of days in the position. Their average holding period is going to be just a couple of days. And other swing traders are going to define the trade as swing trade based on a few months or even more than that. So we definitely want to understand all of those definitions when we talk to a specific trader and we talk about specific trades that they have. Now let's look at Wikipedia, Investopedia, and also NASDAQ definitions for swing trading. So in here, we're seeing, quite, different definitions, on the time frame, but at the same time they are somewhat close, right? So Wikipedia is saying between 1 to several days. So that's that short-term swing trading that I'm talking about. And I think in a lot of cases, it's probably one of the most popular swing trading time frames. Just because, and I think, it's based on how we function as humans. So we definitely have a lot of trades or systems that are based on shorter time frames, and that is reflective of some of the fears, some of the hesitations that we have as humans. So therefore, just go in, take quick profit and go away seems to be kind of like the most riskless proposition. So a lot of the swing traders just stay in that time frame. I think that if you could create an edge for that time frame, you can be extremely successful. One of the most successful swing traders in this time frame is Linda Reschke. And Linda's most preferred timing is just to be for 2 or 3 days in the trade. And she's just incredibly efficient with that type of swing trading. So you just have to understand that time frame. You have to understand the setups. You have to understand the momentum behind those 2-3 days moves. You know, where exactly in the trend you're going to utilize that type of trading. And if you understand that edge, you could be extremely successful. Let's look at some other definitions here. Okay, Investopedia again for 1 to 4 days. And then NASDAQ is saying 1 day to a couple of weeks. And what I don't like about these definitions is that if you are actually trading, swing trading beyond a week or beyond, let's say, a month, you know, where would it fall into which category here? You know, under all of these definitions. It's probably going to be more of the investment strategy for all of these sites. And actually, with the investments, if you're under a year, you know, tax-wise, you're going to be disadvantaged. So to me, anything that is kind of like below a year is still somewhat of a swing trade. You're still trying to take a swing in the market. Let's say if this is 6 to 9 months move in the market after the cyclical low here, and you just swing trade in this particular move. You're not a buy and hold where you just buying here and holding it for years and years and years. You're just taking some of the piece out of the market structure as one of the cyclical moves to the upside, but you're not really spending a lot of time in the buy and hold type of strategy. So I think that for me and for my students, you know, I would rather have a little bit more extensive definition for, you know, swing trading. Okay, well, let's look at the comparison between the long-term investing and the swing trades. And this is exactly what I've just said. Look at the long-term investment opportunity that Monster Beverages, and today we will discuss, you know, specific stocks that were some of the outliers for swing trading for long-term investing, and I'm using those to show you exactly what we're looking for in the selection process. So Monster Beverages was one of those stocks that has produced just enormous return during a specific period of time. And here we're looking at 2008, 2009 lows, and then look at what an amazing advance it had for the long-term trade. We have went from about maybe like $12, $15 on the entry there, depending on where you would be entering in this area right here. And this trade lasted for quite some time until this bar right here, which identified a stop in climactic action, and until this area right here that identified a change of character. So the long-term trade has lasted from 2008 into 2012. There were 1,330 days for that trade, and I'm looking here, hold on a second. So about 400%, so we're entering at 1364. Yeah, that's about right. That should be right. Yeah, 4 times. Yeah, about 4 times, a little bit less. So one of the things that you will see a lot through this presentation, and this is the way how my mind works around it, is that I want to know what the final P&L for the trade that we have. But I also would like to understand what is the velocity with which we're making the money. And the reason why I'm always referring to this number is I want to understand whether this was the best investment possible out of everything that is available to you. So, and when I say everything that is available, I don't only mean the stock market. I also mean maybe like a real estate, maybe like some business ventures that you might have, and so on and so forth. And I know that it goes beyond the swing trading that we're discussing here. But I think if you start thinking in these terms, what is the best investment? What is the best trade? Among all of the investment vehicles that are available to me, then I think that you're going to be on the right track looking for those, and your mind is going to be attracted to those. So annualized return is going to be an important number for us. And here I'm comparing that number to other numbers for swing trades that we're going to have here. And you might ask, well, why do you have only 3 swing trades? What about maybe like a swing trade right here, maybe here, maybe even right here, and so on and so forth? Why are we choosing only 3 in this whole movement? So the first one comes here, second is here, third one is here. And there are specific criteria under which we would pick those particular swing trades. So some of the criteria that we would go through here are not available to us, and we are not identifying this particular area or maybe this particular area or maybe this particular area as of area of interest for us for a potential swing trade. So something is missing there. Obviously, probably not the structure, but most likely just outperformance in those particular areas that does not bring us, to this trades. And look at how the price is moving here, right? So if we would be thinking that, okay, we open the position right here, look at the availability of the supply on this decline, which basically tells us that we're going to have some of the deeper reactions rather than the ones that, we have here in this area. Here, the trade is much more optimal in terms of how the price moves, in terms of how supply behaves, and therefore we're going to make money much, much faster than, let's say, in this area right here. Kind of the same idea here as well, and again, I'm bringing here, more of the supply-demand definitions right now, but you also would be looking at the definitions for relative comparative outperformance. You would be looking at the whole group as well. And if something is not in line with our selection categories, then most likely we're not going to select this stock at this particular time. And looking at this move right here specifically, we might say that, well, it takes a little bit more time, let's say from here to here. So it's like almost 2 quarters compared to like a single quarter right here that has produced a much, much better, quicker return and better annualized return. And the whole idea with the annualized return is just to keep it up at the point where we are entering the swing trades that are going to produce, a much more significant annualized return than a long-term trade right here. And if you are a swing trader, and not a long-term buy and hold type of the investor, then that will be your goal. Your goal is to find the selection that's going to produce, a very good annualized return, and to do this over and over and over and over again so that your average annualized return is going to be, at the very, very high level. And that's kind of like the whole idea of the optimization of our swing trades here. A question: are there any clues in the example of 2008-2009 for most of averages that such big move might occur? So when we are talking specifically, and the question is specifically about like this area right here. So one of the things here that right away catches my eye is how small this range right here is. So therefore, when we talk about the causality as one of the reasons of why the stock could move in such a profound way, we have to think, is there more to the causality than this trading range? And for the long-term investor, maybe entering at this point right here is not going to be the most evident entry because still I would be assuming that the relative comparative outperformance is not quite there yet. And structurally, we have not finished the structure. We might be still consolidating in this area, or we might be going for the sign of strength and then the backing up action. So and it seems like the second structural scenario is unfolding even more. So one of the things, in terms of the optimization for the long-term buy and hold would be, in terms of the efficiency, would be to wait for the structure to develop a little bit more. So experience a sign of strength, then experience a backing up action. And when you look at the backing up action here, as I mentioned, there is a lot of supply that's coming in. We could judge that by the number of down bars right here with the increased volatility. And therefore, we know if supply is increasing, and this is a repeat for us, but again, I'm going to repeat a lot of the concepts that we've discussed in the Advanced Wyckoff course. So just get ready for this, and kind of repeat those with me. I want you to get those in your head and maintain those and see those as we go through a lot of the charts. So on the increasing supply, we are going to require the testing, which is going to happen in this area. This is more of the local test. So after this area, after this testing, which happens on the high or low, probably supply is increasing right here, so you can enter after the local test here as well. But I think that the entry around this area, around 20, even for the long-term trader, would be a much more logical and more efficient entry. And then look at what's happening with the structure. We have completed the structure, and now we're saying that if this whole area right here is a backing up trading range, then we could take our accounts and extend them over to even 2007 right here. So then this becomes a bigger causality, and therefore for a long-term investor, this would be an indication that there could be a potential big move to the upside. And obviously causality is just only one definition for a potential big, huge effect that we could have. We would be talking about the outperformance on the sign of strength rally right here, which is probably quite evident going into 2009. The market was still making the lows at the beginning of the first quarter right here, and the stock is already moving up. So based on that, long-term investor might come in here with the first tranche and just increase that position size and maybe somewhere here, and then on the way up somewhere here. So there are quite a few points of entry for us based on the different structural and relative comparative outperformance ideas. Okay, great. Thank you. Yeah, thank you for the question. And this is how we're going to work, guys. So if you have a question about the slide, just ask me, and I'll see, how appropriate this is and how much time we could spend on this. All right, let's talk about general characteristics for the ideal swing trade. So the first one is, and this is my personal strife, and this is obviously my personal interpretation as to how I see, my swing trading, or how I see the swing trading for my students, to develop in the preferred way. So here are the preferred areas for us to think about for characteristics, of the ideal swing trade that we want to have. We want to find our selection easily identifiable. And this is a very important criteria for me because I want to be able to come to the marketplace, understand where the market is in the structure, and then easily find the selection that I want for my swing trading. I want all of those complex ideas to be simplified to the point where I'm looking maybe at the heat map and I understand instantly what the selection should be. So we'll talk about that. We also want to identify the stocks that are ready to move, right? So what use of it if we are, let's say, entering a position somewhere here, and yet for almost 2 months we have to wait for the stock to actually start traveling. So timing is extremely important, especially for a swing trader in comparison to a long-term investor, because it's all about efficiency. Efficiency of our trading and efficiency with which we are making money. So are we making any money if we are entered here and into this swing trade? No, we're basically consolidating before the move to the upside. So it's a very inefficient point of entry for us. So we want to understand when the stock is ready to move. With that readiness to move, we want to understand that the momentum is going to be our friend in swing trade. And momentum is something that we are looking for, and that we're looking forward to experience. So our entries are usually going to be based on the pre-momentum explosion. We want to enter maybe in the early signs of that momentum occurring with the early signs of that momentum coming into the stock or coming into the market. We want definitely to understand what the trend is, but more importantly, we also want our entries and exits identify for us the movement of the stock or the distance that the stock has that is traveling in this swing trade. That's going to take the majority of the trend. And I usually talk a lot about when we talk about trend following tools as to our intention as swing traders or intention as Wyckoff traders as to where we open and we close our positions and how much of the trend we actually take, in this trade. And it usually goes like this. We are trend followers. We are not bottom and top pickers. Sometimes, occasionally, we will have a clear vision of the bottoming and top informations. And in some instances, we are going to be extremely lucky to enter or exit on the specific Wyckoff events that are going to be very identifiable and that will give us the majority of the trend. But it's not our goal to seek the tops and bottoms in our trades. We would rather see a confirmation of the trend and then get on the trend and move with the trend and trade with the trend. So therefore, it's always about not just definition of the trend, but also about the idea of how much of the trend can we take. We want to understand very clearly where we enter and exit the trade. We want to definitely pick up the stocks that are going to be showing signs of outperformance. And we'll talk about the outperformance that comes before the trading range. We'll talk about some of the outperformance during the range development, and we'll talk about the resumption of that leadership, and that we want to catch that moment where the leadership resumes its course in the stock that has been outperforming for quite some time. And again, those ideas might not be new ideas for those of you who have attended the advanced Wyckoff course or Wyckoff practicum. Again, my challenge to you is to systematize all of these thoughts in your head as we go through those and seek some new, particular nuances that are related to swing trading. and I will definitely help you with some of those. We want to understand our risk management, so we'll talk about the points of entry, stop losses, and we also want to understand how we could actually leverage that. And we'll talk about specifically the switch from the intraday to the daily, from daily to the weekly, and sometimes even monthly. We'll talk about, what are the pros and cons of this strategy, and how we could create a much better, profitability for us out of that switch strategy. And all of this, all of those things that, I've just mentioned is going to be in line with our idea about the optimal trade. So what is the optimal trade? It's the trade that creates you the largest possible net result in the shortest period of time, using our proper leverage or proper instruments that we are using, and also reflecting your personal risk aversion profile. So in a way, it's a idea that of optimization, not just at the level of let's say optimization on your position size, and usually when we talk about the optimization, that's going to be the reference, or maybe optimization of the strategy, which would be a little bit closer to what we're talking about here. And by optimization of the strategy, I'm talking about here what are the best of the best ideas that we could generate for this particular trade. And then in terms of the optimization of the trade itself, what are the best entry points for us? And you could see how it relates all to a specific timing of where we are entering and specific timing where we are exiting. As I mentioned before, an entry before would not be the most optimized entry, and you're just basically losing money here by being in this position, not actually losing money, but losing money by being in this position and not utilizing other opportunities that are available to you during this 2 months period. And some of the things that we actually do not discuss in our classes, and you can go to our on-demand products. By the way, we just launched the 20% discount on all of our on-demand products for Christmas time. It's going to go until, I think, the first week of January. And one of the recordings that we have that we did together with Bruce was on practices, mental practices. You really have to understand who you are as a person, as a trader, and how you interact with the market on that, personal level. Because you have to be really comfortable with the risk that you're taking. So some of the strategies that I'm going to show you today are not going to be appropriate for all of you. So understanding your risk profile, understanding your trader type of mentality is extremely important, and you have to, base your system on those mental characteristics. Okay. Let's talk about some technical stuff here. So the biggest question when we look at the chart, and usually that comes during our discussions in the market outlook classes. So let's say a student brings the stock and we're discussing, a possible entry in this area. So to me, the questions are all about why. Why are we picking this stock? Why are we talking about the point of entry in this specifically this spot? And why are we going to be trading, to the upside? So all of those questions of why, and here, slightly differently phrased, what stock, which direction, when, and where exactly on which bar are we going to open that swing trade. And some of the things that we would be discussing, and I mentioned this in the outline, so I'll just go really quickly here, is to leadership. What is it that we are picking? there are thousands and thousands of stocks that are going to move in one direction or another. There are thousands of stocks that are going to move in the direction of the market trend as well. And we could swing trade. There are quite a few stocks that will not move in the direction of the market, and they still going to produce a relatively great swing trade for us. So we want to understand what is it exactly and why we're buying, why we're selecting this particular stock. We want to understand where in the structure we're selecting this stock. We want to understand when the stock is ready to move. And we definitely want to understand in which direction it's going to move. So a question, would we need all criteria for leadership to select the stock, or more is better? And that's a very interesting question because, it has a little bit of different layers to the answer. Probably the easiest answer would be, yes, we want to understand, we would prefer to have the stock that matches as many criteria, selection criteria for the leadership as possible. But there are some nuances as to how we would look at this. And for instance, today we'll talk about how we would swing trade not just a specific stock, but how we would swing trade an industry group that is a leadership industry group, and how within this leadership group that is outperforming, could we find specific spots where a leadership stock in this group is outperforming, and then the laggards are starting to outperform the leadership stock. So even within the leadership leading industry group, we're going to have the rotation between the leaders and the laggards. And that's going to be that nuance that's going to lead us to some specific conclusions for some of the swing trade to switch between, peers here and there. But, as a general rule, obviously we want, as many confirmations as possible, on the potential leadership. So let's look at this example. Two swing trades, and again, this is the Monster beverages. And the question here, at each point of entry, why are we choosing this stock to swing trade? So again, it goes into the definition of the technical characteristics. Do we have a structure here? Do we have any indication of the potential leadership that the stock will experience in the next swing to the upside? Why are we actually thinking that the stock is going to go up? Are there any confirmation by the volume and supply and demand signature that gives us an indication that the stock is ready to move right now? And I want you to look at this and kind of think about all of these questions at these points of entry, these 2 points of entry. Do we have, or all of those definitions, clearly outlined for us? Okay, and I thought I would have the chart just going through this, and I think it's going to come a little bit later on. Yes, so we're going to discuss the we're going to discuss the structure of the same stock. So this stock we're going to use throughout the whole presentation today, and we're going to talk about the structure there. We're going to talk about supply and demand. We'll talk about the leadership as well. So this is kind of like an intro slide on the idea of asking all of those questions. Is this the stock? Is this the best selection? Is this in line with our criteria for leadership? All right, so now, and this is where we enter in kind of like an exciting part of the workshop for me, because this is something that I've just recently developed. Even though I talk with you guys a lot about the synchronicity with the market, And the whole idea about the synchronicity of the market is that it really goes to the idea of the stock, of the swing trade that we are developing. It's not really about the market itself per se. The biggest question here that we want to ask, where are the best swing trades possible for us in this stock? And then we want to synchronize that and have a look at the market, what the market is doing at the same time, and define the environment of the market in which the stock, which is the leadership stock, is going to outperform in the most significant manner. And here we're looking, again, monster beverages, and we're looking only at the upswings that the stock has had. And those definitely, in some cases, are not going to be your swing trades, but the idea here, even if you're taking this move, which lasted for quite some time, for 3 years right here, you will know that at some point that this is a leadership stock and that momentum is going to carry this stock for some time. So the way how to extract some of the swing trading profits here is just to divide this big 3-year swing into smaller chunks and to swing trade those chunks. So for instance, right here I see that there is some kind of stop in action and then some kind of consolidation. There's another consolidation right here. So in reality, I'm thinking that for a swing trader who is a long-term swing trader and who holds his or her positions for, let's say, beyond 6 months, this is the trade, this is the trade, and then this is the trade. So we're going to have 3 swing trades right here. For those of us who are more shorter oriented in our swing trading, there could be multiple trades here even in one area. So there could be trade number 1, 2, 3, 4. But the key here, again, is to understand that the stock or even the whole industry group where to which the stock belongs to is in the uptrend. And it's in the uptrend that is a leadership uptrend. And therefore, this leadership uptrend is going to have different interpretations for us. Usually the leadership that is being established early on in the trend tends to continue. So therefore the outperformance is going to continue for some time, and therefore we want to trade that specific selection. Secondly, that leadership is going to have a momentum behind it, and therefore for swing trading, that's one of the things that we are extremely attracted to. And then also any type of leadership that we're experiencing on the swing up after some kind of resting period, this leadership can resume itself. And again, we're going to be thinking in terms of our time frames. If it took this much 3 years to go up, maybe the next resumption of the leadership also going to be long-term, and therefore our swing trading is going to be based on the same ideas, extracting some profits in the long-term trend, in the group that is outperforming, in the stock that is leading, and we want to make this consistently and with different stocks. So let's look at the best long-term swings here for the monster beverages, and we're seeing kind of like, the start here, 1 swing, 2nd swing, 3rd swing, 4th swing, 5th swing, and look at what the market is doing, or where structurally the market is during those best swing moves that we have here. And again, this is more of the long-term swing move. And let's look at the market. So here the market, in first instance and the second instance, the market is actually in the established uptrend. So that's great. So now we kind of like see and we understand that if we want to trade in the direction of the market, that's probably going to give us the best optimal swing trades if we're synchronizing it with what the market is doing. Here on the way up in this third instance right here, we're seeing that there was a reversal of the market in 2003 after attempt to stop this movement, and the new bull market is taking place. So we have a reversal. We also have an upswing right here, and we also have an area of where the market is actually consolidating. Yet the stock, the leadership stock, is going up. So a consolidation, and we'll come back to this. The next swing comes again after the reversal of the bear market. Uptrend. And there are some areas of consolidation that we could see as well. And then the last instance is just an uptrend. So we kind of see, and probably I should see this, like every time I formulate my thoughts like this, I just have to draw and talk this through. So, but then I really have to put this on the slides. You guys know this about me, you know. But let's look at all of those instances in the market environments of where we're experiencing the synchronicity and the outperformance by the stock. So we're definitely seeing a lot of the synchronicity when the market is traveling up, right? So here are two instances, and here is another one, here is another one, and here is another one. So anytime the market is in the upswing, the leadership is gonna go up, and not only up, it's gonna outperform, and it's gonna outperform in a significant way. So then the goal for us is to identify that market conditions where our upswing trades are gonna be the most profitable. So therefore, we're looking for the environments when the market is trending, either up or down. In this case, you know, we are synchronizing with the up market, so upswings. So any up market environment is going to be beneficial. Second environment that is beneficial to swing trading, and that is going to be somewhat obvious, and at the beginner's intermediate level is going to be acceptable, you know, as the kind of like a mental acceptance of where we could swing trade. I would say it's a consolidation during the cyclical uptrend. So therefore, if we have had an up move and then we are just consolidating as an area of reaccumulation, this area of reaccumulation still suggests that there are stocks that are already outperforming the market, like Monster's Beverage is outperforming the market right here in this consolidation. And it's our task to be more of the stock pickers, you know, during this period of time and find that leadership. Usually, and this is the third area, the third market environment right here, after the reversal of the bear market, and by the way, this consolidation and outperformance, look at this, guys. We're seeing the same type of movement up in the market, but still quite a few areas of consolidation right here in 2010, 11, and then 12. And yet the stock is outperforming the market in a much more significant way. So again, you have to have the environment where this stock market was going up, then consolidating in some kind of reaccumulation pattern or patterns, and then stock selection is going to be based on finding those leadership stocks. So a little bit more complex task than, let's say, a task out of the reversal in the market. After the reversal, there are usually rallies that are going to be extremely broad rallies. That means that the majority of the stocks after the oversold conditions are going to be bound to reverse with the market together, and they're going to be bound to bounce up in a very meaningful way. So in these two cases here, and you know, with 2015 when we had, you know, this type of movement, we also will see how broad the rally here is, how broad the latest Trump rally is, in this case, and how broad this rally and this rally is. And we're seeing that there is a lot of momentum after the reversal. So therefore, those type of swing trades are going to be somewhat easier, from the selection purposes. And the trades that we're going to have here in these areas right here of consolidation are going to be more difficult for us in terms of what we are selecting. So we have to be more of the professionals, on the selection during those periods. Let's look at the down market. And here I'm using an Apache, which is the oil and gas exploration stock. And this whole idea about trading against the market's trend is actually not a bad idea. And I have quite a few trades that are being done in this manner, and I'm actually, quite successful with those. And the reason why I'm successful, I think, is because I have an understanding of which stock to trade and when to trade it. And it kind of becomes obvious from the chart of the stock, which is basically in the downtrend here, kind of like a long-term downtrend. Maybe there is an uptrend right here, maybe like a small uptrend right here, but primarily the major moves are to the downside, not to the upside, maybe with an exception of this one. But look at where those major moves to the downside happen, and let's define where the market is during those moves. So here's our first move, and we clearly see here that this moves to the downside is synchronized with the market move. So the stock is going down, the market is going down, the stock is going down, the market is going down. But then something interesting is happening as the market actually, all of it in the uptrend. So the best moves to the downside in the market that is going up for the stock that is underperforming is going to be during market reactions, any type of market reactions, or during some kind of consolidations. So a little bit of the reverse thinking then with the leadership to the upside. What we're looking for is we're looking an answer to the question of when for the market we would be trading the stocks to the downside in the market that is a secular bull market, and yet we have some kind of cyclical reactions. So it's during those reactions that we're going to have an opportunity to swing trade against the secular bull market. And the way how we would be finding those stocks is through our structural analysis and through our comparative analysis. And we want to find the stocks that are in the complete distribution pattern or very close to it, so somewhere close to maybe like phase C right here, that is showing maybe some signs of underperformance. So for instance, maybe like after this bar right here, there's still a swing trade available in this area right here, so you can use that to your advantage and take out this swing trade right here. And then maybe a more profound underperformance where the market is going up and showing some sign of weakness for the next reaction to the downside, and the stock is actually heavily underperforming and has the structure of an upthrust right here. So a trade to the downside in the market environment that is going down is going to be extremely appropriate. I would call this a more advanced trading, so I would definitely advise not to have this type of trades if you're not clear, as to when and what to trade in the market that is going up. But look at such wonderful opportunities that some of the market reactions or even consolidations give us in the stock that is showing that type of weakness, that is showing us a a counter trend to the market. It's those type of stocks that are going to produce the most result during the down market. Or, when I say the down market, obviously I'm referring to the reactions in the, secular bull market right here. And the reason why I talk about this is, again, it's all about optimization of your trading. And we're talking about optimization of trading from a different perspective right now. So imagine that your equity line just reflects the market action. So let's say that your equity line is just this. Basically, this is what you're doing. So this is great, but yet you have all of those dips in your equity line. So how to deal with those? So you have to have some kind of hedging mechanisms during these periods of time when the market is behaving counter to the major trend. And if you want to optimize your equity line and you want to make your equity line look more like this, that kind of like steadily goes up and has fewer of the reactions, then you have to think, what are you doing at, in these places where the market reacts to the downside? One of the strategies is to basically counter swing trade the market. And this is exactly what I'm showing right here. So you have to understand what and when. Okay, and we'll come back to all of those ideas. A couple of questions. Should we look for synchronicity on a monthly time frame? Can we do it on the weekly? Yes, absolutely. So we would do this on the time frame that you're trading. And obviously, when we look at the market structure, we want to synchronize like this whole area. And you can do this both on the weekly and you can do this on the daily, so it doesn't really matter. What's important is just to understand that if the market reaction starts, then I'm going to go into the stock and synchronize that start of the market reaction with the movement in the stock. And I want to make sure that the stock is moving in the direction of the market, and obviously other criteria like underperformance are already there for us to say that this is a good candidate for us to swing trade to the downside. Do those sharp reversals mean urgency of buying? And I'm assuming that we're talking about this reversal right here, maybe like this reversal right here. So those sharp reversals. Yeah, absolutely. There is an urgency of buying for different reasons, and we are going into the narrative here of the institutional buyers. What are they doing here? What are the institutions doing? So obviously, there is a heavily oversold condition right here based on the macro and fundamental environment that we're currently in 2008, 2007, 2008, 2009. So institutions are seeing some value in this oversold condition. And I'm not necessarily talking about the technical condition, oversold technical condition. I'm talking about the valuation of stocks at that particular moment. Institutions are seeing that stocks are heavily under valued, and that attracts them based on their models that they have. They are not necessarily technical models. They could be based on just fundamental factors or macroeconomic factors, and they're seeing value, and they're seeing that going into the future there's going to be some kind of restructuring, whether of the economy, which is based on monetary fiscal policies, or restructuring, let's say maybe like in this instance right here, restructuring of the specific company, and that could lead also for the restructuring within the industry group for that particular company. So therefore they're seeing this undervalued proposition and they're going in, and there is an urgent bind on the way up. Usually out of the oversold conditions, this is the way how we're going to move out of this type of sharp declines. Okay. So now let's talk about kind of like the timing of where we would be considering our swing positions to be opened. And this is a usual question that I get during any of the up moves that we've had. I can't actually remember a single upswing where students would not come, let's say, somewhere maybe like right here, right here, right here. And the question that they would be asking is, how could I swing trade either the market, what do I do here at these spots in the market, or let's say a stock has advanced, like Goldman Sachs has advanced so much and all of the financials has advanced so much. How do I trade this stock? And I think in a way, I mean, it's an appropriate question to ask because it leads to the exploration as to what you're doing right and what you're not doing. But in a way, it's kind of incorrect question at the incorrect time. So the typical question is going to go like this: how can I swing trade this particular stock at this particular spot? And usually my response is going to be, well, who are you as a trader? What is your time frame? And by the swing trading time frame, I mean the average holding period for any of the winners that you have, let's say on the upside. So when we define an answer, and let's say the answer is up to a month, so the average holding period for this particular swing trader on any of the winners that he or she has to the upside, swing trading to the upside. Please note that swing trading to the downside might have a different average holding period just because velocity is so different. And let's say that the answer is up to a month. Then my response usually is going to be that it's too late. It's too late to get into the stock for to have a meaningful profit potential on the swing trade. The only possible scenarios here that could unfold is that the stock might continue its move to the upside and then reverse for some kind of reaction after this prolonged move to the upside. So therefore, we would be thinking what kind of trades are available for us here at this spot. Only very, very short-term, either intraday or short-term swing trades, maybe like a couple of days to a week, maybe slightly more, maybe slightly less. And then the next trade that's going to be available to us is to the downside. But then if to the upside, we're having a great selection, then to the downside, we're not necessarily having the greatest selection just because of the outperformance to the upside that we have. So therefore, it's extremely important for us to understand the intention for this question. How can I swing trade this stock at this spot? And the intention behind the answer for this question is in the next action that we do, the next trade that comes. And for the next trade, we want to understand how we could find this selection prior to the move happening. And we want to go to other stocks and maybe identify the same conditions under which the next move is going to have a lot of momentum, is going to have a lot of leadership, is going to have a lot of institutional participation and sponsorship. And we want to understand that from the perspective also of where, at when, and where in the market structure we actually enter in this stock. So for instance, what was the best entry right here? Well, obviously the first 3 days after the reversal, pre-election and then on the after election day, all of them were appropriate for us to enter into the swing trade and to experience this type of move. So therefore, all of these spots where the market is giving us an opportunity to go in and to establish meaningful swing positions, we need to explore. The question becomes is how? What could we do here, to find that market entry? So and here is a simple table that I've created in preparation for this workshop. This is something that maybe I've mentioned, during the advanced Wyckoff course or Wyckoff practicum, market outlook, and this is my definitions for swing traders, who they are in terms of the average holding period and how I look at the long-term buy and hold investor type of trading. And also, we're going to go here through different points of entry and the definitions of where we would be more aggressive, as swing traders. And obviously, this all relates to the market, to where we see the market is right now currently. So let's go through this. So we have a long-term investor, and I usually look at this, and I'm a little bit stretching here the definition. I would prefer the long-term investor to be 9 to 12 months. But majority of our traders are much shorter oriented. The majority of our traders are actually in this category, short-term swing traders, from 2 to 5 days to about 2 months. Working with this type of traders, I always push them to go to the next time frame. And the reason why is because the next time frame creates a much more profitable proposition for us. If we are in a winning trade in this time frame, in the long-term swing trading time frame, we usually will generate a much bigger alpha. We usually will be staying in one single trade for a longer duration of time. Think about the efficiency of that trade. If you are making basically the same annualized return on this trade, and maybe kind of like the same close to annualized return here, then having fewer trades is going to be more beneficial to us. Why? Well, obviously the first thought that comes is the commission, right? And I was talking to one of my private clients yesterday, and he was showing me his trading day in oil and gas markets. And I was asking him, are you profitable for the day? And he's like, yes, I'm profitable. How much money have you made on a single contract? And he said, I made $100. How many trades have you had? And he said, well, I'm trading, intraday trading, and I have had over 17 trades for the day. Okay, so how about the commissions? Do you account the commissions for that? So that's the first thought that should come when we talk about the number of trades. What is your commission expense? And he's like, with commissions, I'm probably going to be at $50 for the day. So the next question that I asked him was, if you would hold, and if you look at the chart of the oil for yesterday, the market was going up there. So I asked him this question: if you would have opened the position where you first saw an opportunity and where your first trade has been originated, and you would just hold on in one single trade with even one contract through this whole uptrend, how much money would you make per contract? And he calculated that, and he said, I would make over $500 per contract. So a drastic difference between a number of trades, 17 trades for that day, number of commissions that he's paying, number of mistakes that he has made going counter trend, trying to catch those small swings, and somewhere, to the downside, he did have some profit, but that was negligible. The number of trades are so different, and the profitability is so different. So therefore, my intent is always to push people to a higher time frame. This is where we're going to have fewer trades, and this is where the profits are going to accumulate and compound a little bit more. This is more importantly, again, I mentioned the number of mistakes. Especially at the beginning and intermediate level, you are bound to make mistakes. You have to. how you're going to experience your whole trading, how you're going to improve. You have to make mistakes, reflect on those, adjust your execution or your strategy, come back to the market, have another experience, and based on that experience, whether it's positive or negative, make those adjustments again. So therefore, going to a higher time frame creates a unique opportunity for us, to be more profitable in a more efficient way. So it's kind of like my personal goal, to do that with my students, to push them a little bit, to a higher time frame. But I want you to see the logic, the rationale of why I would do that, and that is why. All right, so let's look for all of them. What kind of trends are we going to consider for those type of traders? So trends in consideration. For long-term investor, we're going to look at the secular trends with cyclical lows. So think of the secular trend as the beginning of the 2009 rally, and then cyclical lows are going to be your low in 2010, 2011, 2012, October of 2014, lows in August, September of 2015, January, February of 2016, Brexit low, and the election low in the US. So these are the lows that are going to present the best entry opportunities. And usually, if we're going to quantify that, we're going to be talking about, specific drawdowns in the market. So for a long-term investor, a drawdown of 20% in the market with the cyclical lows between 10 to 20% is going to be the most opportune time to consider entering the market and establishing the positions that are going to be held, through the whole, business cycle, or, a cyclical move, or maybe a secular buy and hold strategy. For the long-term swing trader, we're talking about cyclical trends with short-term counter moves. So we're talking about a cyclical low in 2010, 2011, and then having maybe a backing up low or any type of reactions, counter moves to the up move. And those are usually going to be, your cyclical lows are going to be between 10 to 20%, and your counter trend reaction moves are going to be between 1 to 5%. So if we recognize that as an opportunity in the market, then we will know when exactly we should be extremely active with our selection algorithm. In a way, you kind of can do this. Let's say if you are a long-term swing trader, you could recognize an opportunity right here, and then just because you're already in the positions, just stay with the market and do nothing, and just experience those trades that you've established in these areas right here. Then recognize this cyclical low and recognize the backing up action right here, and then stay with this trade until it's done. Again, recognize a reversal right here, backing up action, and then stay with this trade right here. And that's the whole idea behind of why not enter here? Why not enter after we've already had such a big move? So you have to be aware, cognizant as to who you are as a swing trader and what kind of opportunities the market's going to give you. And when these opportunities come to the market, you have to be extremely aggressive, at those spots. Best add-ons, obviously for the long-term investor, all of the cyclical lows with the 10 to 20% declines are going to be extremely great opportunities. For the long-term swing trader, any type of counter trend reactions or stepping stone trading ranges are going to be the ones that we would be looking at. For the short-term swing trader, the add-on to the counter trend reaction lows that where we're going to initiate our positions are going to be any type of breakouts after smaller reactions. And then for the aggressive buying, we definitely, for the long-term investor, we want to experience, a change of character with the sign of strength in the backing up action as a confirmation. The same for the cyclical lows and change of character for the long-term swing trader. And then for the short-term swing traders, again, any type of breakouts after smaller reactions are going to be appropriate. And then for the exits, we are basically looking for the change of conditions, the change of environment for us, change of character in any of the time frames. And the only difference between those changes of character for different traders is going to be the magnitude of those changes. So for the long-term investor, we're going to be seeking, cyclical and secular changes. For long-term swing trader, we definitely want to see a cyclical change of character, or I probably should add here, or just a long-term swing change, where within the cyclical move, we have the change in the swing, in the character of the swing, and then any short-term changes of character for a short-term trader. So let's look at the market and let's kind of identify those places for us where we are, for swing traders, are going to see the best opportunities for us to enter and the best opportunities for us to exit any type of swing trading that we have. The question here, which time frame structures we need to consider to do analysis for each of type of swing trader and investor? Well, the structures or the time frames are going to be relevant to your time frame. So for the short-term swing trader, you're going to be looking, and I think it's a good question, maybe something for me to refine this slide on, and just to add this point. So the time frames, let's say for the short-term swing trader, we would be looking for any of the trade ranges that are going to last up to, let's say, up to 2-3 months. Anything in between of a week and 2-3 months are going to be appropriate. For the long-term swing trader, we actually want to increase that time frame, and we want the range to develop maybe from 2 months to about 6 months, maybe even more to a year. And for the long-term investors, I think what's more crucial is even not only the duration, but also the understanding that there is a cyclical or secular low that is being made, and therefore, the ranges there could still be quite small on the reversal itself, but then the structure could develop with the sign of strength in the backing up action. Yes, and any type of stepping stone ranges here that are being referred to the aggressive buying, and you have to specify which type of trader you are. Okay, so let's look at this case study. And again, we're going a little bit slow here than I would prefer, but again, this is the material that I want to concentrate today on, because I see a lot of mistakes that are being made that way. So I want to make sure that we as a group go through this material and we understand specifically, what is market giving us in any of the historical examples that we're going to go through. And as we go through these examples, we'll talk about different definitions for how would we define the change of character, in a more quantifiable way, and what would we be looking for? What kind of sequence of events are we looking for the definition of the market? And we're going to do this for 10 minutes, then we're going to have a break, our first break, and then we're going to come back at 10:30. So you might hear an alarm going on, and that is the alarm on my phone, just to tell me that the time to stop and to have a break. Okay, so we're looking at the S&P 500, and I took the whole history from 2000, and I just wanted to put all of the slides of this last 16 years and to show you that this concept works so well. Maybe there are one or two instances where it's going to be under question for some reason, and we'll talk about that. But if you are going to use this, I think you're going to be very consistent in identification of a long-term, intermediate, and short-term trends in the market. You can take this concept and you can even apply it on a shorter time frame. So for instance, you can take this concept, and I'm using the daily here, but I would experiment even on the S&P with for this concept with the shorter time frame, maybe even go to the intraday, and maybe this is something that I'll do for the intraday workshop that we're going to have in March. So let's just jump right into that. Before 2000, we definitely have had a very big bull secular market that started. One of the major lows was in 82. One of the lower lows was, I believe, in 75. And it's been going up, 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 up. And the last move to the upside was from the lows in 99. And then the market had just like almost a vertical move to the upside. The first reaction that came as a change of character was right here. And it was more significant in NASDAQ than in the S&P, but still, even in an S&P, the percent with which it went down, and I'm identifying here the number of points and the percent that for this swing to the downside. It was a significant swing to the downside, and it actually identified the change of character for us right here. And then one of the things after the change of character, we also say that the price is going to consolidate, and it does. If we were to resume the course to the upside, we would have a change of character that's going to come out, going to commit above the resistance, back up, and then continue. So we would measure this move to the upside. And what we need to see in this move to the upside is that not only the volatility contracts, so let's say from -14 to -8 to -7%, so there is some contraction of volatility right there, but that this move to the upside is actually much more than any of the moves to the downside that we have right here. And we definitely don't see this. We see the failure here and then just continuation to the downside. Please note how volatility is so important in the definition of what market is going to do next. We had a big decline right here, and then we are repeating this decline with almost the same number, almost 15% right here to the downside. So instead of the change of character to the upside, we're seeing a change of character to the downside. And we're going into the next trading range, and look at how volatility still increases, and increases to the downside. So volatility increase acts as a confirmation of the current trend that we are in. And obviously here we are in the secular bear trend, where we would expect that volatility is still going to stay high to the downside, and volatility to the upside might increase in some instances. But what we want to see in all of these rallies, and this is where a mistake comes very often, is that this acts only as the initial confirmation that we might potentially reverse the market or reverse the trend. What needs to happen after this confirmation is decrease of volatility on the next move to the downside. But instead of that decrease, we actually not only matching the previous volatility to the downside, we actually increasing the volatility. So all of this is just confirming. Every time we have a move to the downside like this, we're still in a downtrend until it proves to us that volatility is under control, and we might have the rally that's just going to start outperforming anything in the trading range. So let's look at that. And we're probably going to stop after this slide. This is the last move to the downside that we have for the market. And look at the numbers here. Almost 35% down on the S&P. What happens next? We are experiencing a change of character to the upside that is on the in to a trading range, right? So we have to have two changes of character. One is on the way to the trading range, and then the second one on the way out. So here is our first change of character. Why is this change of character? Well, because the rally that we are experiencing here is so much more than anything, any type of rally that we've experienced on the last move to the downside. So we have our first requirement for the idea of the consolidation. Once consolidation starts, we want to make a note of the volatility on all of the reactions. And we're seeing how volatility is starting to decrease, which is a good thing for us here. And we want to, as the next step, we want to identify a bullish change of character. And not only a change of character, but we want to identify the rally that's going to outperform any of the declines and preferably any of the moves to the upside that we've had in this range. And 28% is definitely outperforming anything after decrease of the volatility here in this area. Not only that, we're seeing how for the first time the market is actually making a new higher high and committing above the resistance, above the structural highs. Right here, as we look at all of the attempts to go up, let's say after a change of character, we have a higher high, higher high, higher high, but we don't have a change of character. Enough rally for us to say that there is a change of behavior. Here, in this instance, we have lower highs. So none of the rallies are outperforming in a significant way. Here we have a very substantial rally, but nothing comes afterwards. There is no change of character afterwards, and we still have an increased volatility to the downside. Here, the same thing. There are no highs that are coming after this initial high, after the potential change of character, and volatility still increases to the upside. Look how different this picture is from what we've seen. Move to the downside, change of character on the way in into the consolidation, and then the next move right here to the upside. Both commits to the upside, produces the rally that is more than anything that we've seen to the downside, more than anything that we've seen to the upside, and with that, look at how volatility contracts on the backing up action right here. So if we're thinking about volatility as the concept of the potential market reversal, and specifically for accumulation here, we are seeking the volatility to decrease as a confirmation of that reversal, then we are having most volatility at the climactic action, and here is the alarm, decrease of the volatility throughout the structure, and then decrease of the volatility on the most meaningful reaction after phase C, which is going to be a backing up action. And we're seeing how the backing up action is just a meager, 6% right here, or 5%, between 5 to 6%. So we are gradually decreasing the volatility to the downside and confirming that volatility is decreased enough for the market to reverse its big move to the downside and continue with the move to the upside. During this period of time, we're going to experience smaller reactions right here. And look at those smaller reactions. Where are we with that? Do we have anything that just going to give us some kind of trouble here on the increased volatility? 6, 5, 4, 6, another 6. So volatility has decreased significantly, and that's a reflection of the change of character as well. So all of those things, including also the higher highs and higher lows after this, so obviously a higher high here and a higher low right here, That's how we would define a change in the market environment. And based on this change, we're gonna start making our bets depending on who we are as traders. Again, you know that table that we've had. This is the table that's going to give you the understanding of, let's say, if you're a long-term investor, you want to identify those secular cyclical lows, and you want to start putting the positions on the possible reversals there and be more aggressive after the confirmation of that change. So for instance, for the long-term investor, as we're experiencing a low volatility right here, after a very significant move to the downside, we might be inclined to start opening the position maybe somewhere here in this area. And this is going to be just tranche number one. And then once we have a confirmation right here, we're going to be extremely more aggressive. We could also have another tranche opening right here on the sign of strength as a possible confirmation that we might experience a different type of rally. And then point number 3 right here. The next point for us as long-term investors would be on some kind of stepping stone type of action, a significant stepping stone. So this is a significant stepping stone, and we would, when we come back, we're going to start with this. We're going to come back with an idea of where the long-term investor would be establishing a position right here. And also we'll start talking about swing trading, you know, where the swing trading opportunities here, where the market gives us that opportunity, you know, to be more aggressive with the swing trades. All right, guys. So at this point, and we'll address some of the questions that are coming in, you know, at the beginning of the next session. I'm going to close this session, and then I'm going to reopen the second session. You should have the webinar link to that second session, and we're going to start promptly at 10:30. So we're going to have a smaller break right now, so about 6, maybe 7 minutes that we're going to have. All right, guys. I'll see you in 5 minutes. Thank you.